If you figure out how to lose money with your trading strategy and you fix those mistakes, then you will have a better investing strategy. So welcome back to my channel, and in this video we're going to take it slow and show you how you can lose money with selling cover call, so then you know what is the common mistake and pitfalls and how you can avoid them in the future. So let's talk about what is cover call. A cover call is having 100 shares of something, and then afterwards you sell an option contract selling a call, and you earn an interest premium over a period of time. Now, usually people do this over a 30-day period, and if they are able to enter into an option contract and the stock stays above a certain price, then they make money and they keep the interest. If the share price is below the stock price, you still make the interest, but you'll also have an unrealized loss on the shares. So let me just quickly show you what I mean, and then we can talk about how this can potentially go wrong. All right, so here we have an Excel, and let's start with Apple. Okay, there's 100 shares of Apple that you need to purchase first. And then right now, Apple is $138. So that means the cost will be 100 shares times 138. And this is a dollar value, 13,000. Now you can sell a cover call on it. And let's say you choose a strike price. That is also 138. And you do that 30 days from now. And we can take a quick look at the option chain to see how that can be done. So we go here and we go to, let's say, December 9th, 2022, which is a little bit more than 30 days, which is fine. And then we can choose 138. And you can see the call here. It's approximately $6.4 is the midpoint. And this can fluctuate depending on the market. So it's 6.4. Now, when you're looking at a cover call, an option contract represents 100 shares. So you need to take the 6.4 times 100. So that is the amount of interest you'll get for selling a cover call. If you calculate the return on this cover call, CC, then it's approximately 4.6%. And it's rounded to 5% by Excel. In around 30 days approximately. Okay, so that means as of this point, if Apple stays above $138 in the next 30 something days, then you would make $640, which is 4.6% in 30 days. So that is actually quite an attractive return. And that is one of the strategies for monthly passive income within Investing Accelerator. So if you want to learn more, you can check out 5minuteinvesting.com/free case study, which is in the description below. So great. Now you know how to make money. So now the question is, well, how can you lose money? So let's say the price as of the end of 30 days stays above 138, which is your strike. If that is the case, then you keep the 640 and that's it. Now, if Apple, let's say, goes all the way to 180 here or 170, it doesn't matter. Your gain is capped at $640. That's how a cover call works. So the real problem is when price is below 138. Now, if price is below 138, then what you will have is an unrealized loss of the 100 shares. So 100 shares, let's say the price is, 135. All right, so then now your shares is worth 13,000. And that means you have an unrealized loss of $300. Now, as of this point, if you're normally just buying 100 shares of Apple, then yes, you will be losing $300. But because you have the cover call, that call will be expiring worthless, and you sold that call, so then you earned this $640. So you actually have this plus 640. So then your net gain or loss after 30 days is $340. So at $135, you're still making money with your cover call. And this is actually quite interesting because it reduces your loss in 30 days, even if the market went against you and you didn't short the market. You just have a protective measure. Now, what you give up is any additional gains above this 640 amount within the next 30 days. Okay? Now, what happens if it dropped more within the 30 days? So let's say it goes to 130. Then that means for 100 shares, it'll be 13,000. And the loss will be 13,000 minus 13,800. So you're losing $800. Okay, but this loss is reduced by the 640 you make from the cover call. So just to make it clearer. And that means your net loss will be $160 before including transaction costs. So you can see if you use 100 shares, buy and hold Apple for the next 30 days, and it went from 138 to 130, you'll lose 800 normally. But if you are able to use a cover call, then the interest premium you earned have already covered a good portion of the loss. And you're only losing 160. And after 30 days, then you can sell another cover call again, and you can make that premium. So that's how cover call works. And I also explain how you can lose money. So then now you can do this for other stocks that is not just Apple. So the question is this a good company for the cover call? And it really comes down to analyzing the company itself, looking at the fundamental analysis, like the income statement and the balance sheet. And you also need to look at timing. So for example, if you're looking at the upper right corner here, Apple went from $152 last week to $138 within a week. So imagine if you sold cover call here, $152, then you would still be in the red because it dropped to $138 within a single week. Even if you're getting a 4% premium in 30 days, within 1 week, you are already in the red. So the timing in which you sell the cover call actually matters. Now, another disadvantage when you're selling cover call is that most people are selling at the current stock price. So what I mean by that is, let's say you are selling one cover call, $138 a share, and you're selling a strike that is $138. So when you're looking at this, then the probability of your success is actually around 50-50. So 50% chance it might be higher than 138 after 30 days, and 50% chance it might be below 138 after 30 days. So if you choose a different strike, let's say it's lower than the current price, then you might have a better probability than 50%. So first, timing matters, and second, your strike price matter. So let's say you choose a more conservative strike, and the interest you earn, it's also lower as well. So you will see there's a balance between risk and probability. So in this video, I'll mainly go through cover call and not the other monthly passive income strategies. But let's say you choose a strike that is lower than the current price. So 138 is the current share price, and your strike is 130. So meaning that your shares are cost 138,000, but then your strike is lower. So then when you sell this call and it gets exercised, you'll automatically be losing $8. So then you need to get compensated on that based on the call price itself. So that means if you're looking at the strike 130, you'll realize it is a lot higher in terms of the option price compared to 138 because there's a difference between the 130 and the 138 today. So that's why you get compensated. So the real interest you're earning, let's say it's $12. So 12 times 100. There you go. And here, we know that when the cover call gets exercised, you'll be selling those shares at 130 instead of 138. So that means as long as the stock price stays above 130, you'll be selling the shares at 130. That's what the option contract means. You already have a loss of $800. So that means, let me just fix up the sign for you. Option price. Okay. And the premium you get for selling a cover call with a strike that is lower, it's $400. And the capital you use is $13,800. So then your return is 2.8%. Rounded up to 3%, 2.9%. So this is still pretty attractive. Now what you're saying here is that right now Apple is $138. If you sell a cover call at $130 and Apple stays above 130 within 30 days, then you'll make your 2.9%. If Apple is below $130, then you will need to calculate the gain again. But if it drops past a certain point, then you will start to lose money, and that level will be a lot lower. So let's calculate how much does Apple need to drop in order for you to start losing money. Let's say the share price, it's going to be 128 when you exit. So then at this point, your loss here will be 1,000, but then your option price or gain is still 1,200. So you're actually still in a net positive position. So if I go here, okay, it's still $200. So even at 128, so this is actually a much safer cover call than the one previously, but it's just that the return is lower. Now, if it drops more, like 126, then this is when you break even. So at 126, your loss for the option is 1,200, and your option premium gain here, the reward you got, is 1,200. So then net, so if Apple drops below 126 within the next 30 days, then that's when you would lose money with a cover call strategy. So that is really the basics of cover call and how you can lose money with cover call. If you're interested in getting this template to look at the market to see when it is a good time to buy and sell, then you can check out the free training in the description below. So you can grab this template for free, and I have a step-by-step video that teaches you how to set this up. So here you can see that usually when Apple is in the middle of this blue band or near the bottom is when it is a good time to sell a cover call. If it is near the high of the band, that is really when you need to be careful because there might be a reversal happening, and then if the market goes against you, then your cover call will be losing money because the share price is going down even though you earn the interest premium. But usually cover call is a fairly conservative strategy because you earn that interest even if the market goes against you, and the upside you give up is when the market is really bullish and exceeds that interest premium. Okay, so you can let me know if you have any questions.